session for you all, whether you are yourself a professional or a client who perhaps has thoughts or even issues with your own inheritance tax situation. So just a little bit of a compliance slide before we begin. This is just explaining that, in essence, this presentation, it isn't advice. I'm not telling you what to do or what not to do. It's just hopefully very helpful information that you can use to make your own informed decisions. But we always recommend getting personalized financial advice before you do. And of course, as this presentation will go into, and you've probably all seen in the news over the last year or two, tax rules, regulations, legislation, they do all change. As far as we are aware, the information in this presentation is correct at time of sharing, but these things can change and these things are complicated. And whenever we're talking about investments, they are not guaranteed. They can go up and down in value, and you can lose more money than you invest. So with that out of the way, let's get into it. So a little bit of a background for those of you who've not met me before. My name's Oliver. I am part of the wealth management team here at TBA. I'm a chartered financial planner. I have been doing this for over 10 years now, and my expertise lies within pensions and retirement, though we are whole of market independent financial advisors, so we do all sorts of different things. And as we'll discover during this presentation, retirement planning and estate planning are increasingly going to become intertwined. I don't think you realistically are going to be able to do one without the other going forward. So it's going to be a busy time for people like me, I'm sure, with all the changes going on. And just to let you know as well, there's another advisor on our team called Martin Card. He's my boss. He is also a chartered financial planner, but he has many more letters after my name to represent the fact that he's been doing this a lot longer than I have. But between us, we have over 40 years of experience in financial advice here at TBA Wealth Management. So what are we going to cover today? So the first one is really going down to basics, but what actually is your estate? How do you know what it is? What's included, what's not included? It's obviously a very big starting point. We're then going to look at why inheritance tax is a worsening problem. So I'm sure as you've clicked yes to joining this, you're already aware of inheritance tax or estate planning to some degree, but perhaps you're not aware of just how monumental the changes have been in the last 2 years and why it's going to be an increasing focus for a lot of people. I've got a very specific case study which I think highlights some of the common misconceptions we see around estate planning, which I think will be quite illuminating anyway, unless you're already an expert. We'll then look at how you can assess your own liability. So once you've figured out what actually is your estate, what is your tax bill? Do you have a tax bill? I do work with people who are very worried about these things, and when we actually look at it, they don't actually have an inheritance tax liability, nor are they likely to. But if you do have one, how do you actually calculate that? And then once you figure that out, obviously we think about what to do with it. So options for mitigating and paying that inheritance tax. We'll have a specific look at trusts because they are probably one of the most misunderstood areas of estate planning that we see. There's a lot of misconceptions, and I'll cover the main one in that slide. And then some further case studies just to give you a feel for the different scenarios that estate planning can cover. And you may find one more or less familiar than the others, but just to give you a bit of an overview about what people are facing in today's world. So what actually is an estate? Quite simply, it's basically everything. Anything that really has a material value, so cash, property, personal effects, so if you have any jewelry, art, car collection, pensions, with a small caveat from April 2027 onwards. So they're not just there yet. So if you die now, they won't be in your estate, although we don't encourage that as a planning option. And importantly, gifts that are younger than 7 years, which we'll come on to. But effectively, everything you can think of that has a value, HMRC, will want potentially a cut-off. So it's important to include everything. I do often come across clients who think that if they stash their jewelry in the walls, nobody will ever find out. But you're rolling the dice against HMRC. They are very good at investigating these things, and you should always endeavour to report and pay the tax as appropriate. So that's quite an easy one, really. It's just everything. So small added caveat here in terms of the pension side of things. It's probably a big reason why a lot of you have joined, I might imagine. So in the 2024 budget, we started hearing about the changes to pensions. So pensions used to fall outside of your estate. They were not included, therefore they were not liable to inheritance tax. And effectively what the government have done, a slight distinction here, the pensions won't form part of your estate. They won't be subject to probate, but they will be liable to inheritance tax. So they're chargeable, but not in the estate. It's just an initial thought for you to just how complicated they seem to be making the rules around this change. They're not making it easy. And this is going to significantly increase estate planning needs, quite simply. For example, if you just have the audacity to get a good job and buy a house in the southeast of the UK, those two things alone over time could well be putting you towards the estate planning thresholds. And then if you throw in the pensions, it could push you well clear. So we believe, and projections for inheritance tax bills by HMRC support this. A lot of estates who previously has found themselves under the thresholds are going to find themselves caught out by this. And the issue with pensions being brought in is they are only partially tax-free. So 75% of your pensions will be taxable. And one of the big issues from a planning perspective is for the last 10 years, pensions have been IHT free, and that is what planning has revolved around. People have often been using pensions as a last resort for spending while they're alive. The government has seen that and said, no, pensions are for your retirement income need. That's what they've always been for. But with this change in 2015 under pension freedoms, that shifted, and they've decided they don't like the way that's going. They're not designed to pass on tax efficient intergenerational wealth. They want people to spend these pensions in their lifetime, and would you believe it, they're taxable, so the government are going to get more income tax. But it's not something that you can suddenly give away a pension because of the tax implications. It's something that's going to take time. It's going to require a lot of reorganization of a lot of people's financial plans, unfortunately. But this law is happening. They've done a consultation, but it's very firmly on the how are we going to do this, not do you think we should do this. So come April 2027, things are going to look very different. So that case study I mentioned, this is one of the common misconceptions we get. So we've got a chap here, Mr. A. He is 75, he is single, and he has no children. He has a property worth 650,000. He has cash worth 50,000. He has pensions and investments of 300,000. A total estate value of a very tidy and clean £1 million for my example. And why might there be issues with the executors of Mr. A's estate paying inheritance tax? So that's the main one. Based on the current rules and exemptions, and assuming the April 2027 pensions are included, so we are jumping forward a year here, that would be a tax bill of £270,000. Over £250,000 of inheritance tax will be due from Mr. A's estate when he dies, if he dies immediately and takes no action. His nephews are going to inherit his estate, but how do they actually pay the £270,000? People often look at the estate, the value, the estimated tax, but what about the logistics of paying that? We know there's not enough cash. He only has 50,000. So he can't just, for example, ask the bank to pay directly to HMRC, even if they let him do that, as not all banks do offer that. Pensions are chargeable to estates from April 2027 again. So in theory, prior to this change, pensions outside of the estate, they could be inherited by beneficiaries, which are different to executors or personal representatives. You could, in theory, inherit the pension separately without probate and use it to pay the inheritance tax. Again, though, that has its own issues. If you die after 75, all of it is taxable. So generally speaking, pensions wouldn't be the most tax efficient way to pay an IHT bill, but that potentially is an option, but it's not a clean and easy decision to make. Oops, sorry, my screen went blurry there. Let's go back to where we were. So the big issue is he can't sell his house. Well, the executive of the estate can't sell his house yet. They need probate. To get probate, you need to pay £270,000 of estate tax to HMRC. So it's sort of a catch-22. The house is the majority asset, but it's illiquid and you're not going to get access to it. So they need to find some way of finding over £250,000 within 6 months, because that's the deadline to pay HMRC inheritance tax. So that's a bit of an awkward situation to be in here, where if there wasn't any planning done, his nephews could find themselves in quite an awkward, sticky situation where they're going to struggle to find an effective way of paying that money. And, you know, it's not a nice problem to have suddenly foisted upon you. You know, how long is a piece of string? None of us know when we're going to die. It's why having a plan in place is so important. So what can they do? It's not to say there's no options for them. It's just the options available to them, they're going to be more last minute, they're going to be more stressful, and they're already going to be in a position of bereavement. It's not something you want to really be in a situation of without a plan. But we'll go through the options. So they might be able to pay directly. Some banks, some investment houses do allow direct payment services where they will just simply pay the value of an investment or a bank account to HMRC to settle any inheritance tax due. That system is optional. And if you, again, don't have the plan, if you've not checked in with your investment providers, with your banks, and asked them that question, you might be planning on it going, oh, he's, you know, maybe he's got 100 grand in cash, we can use that to pay it. And the banks say, no, we want probate. Back to that square one there. Sometimes HMRC can agree to a payment plan. This is especially common if the majority of the estate is within property. As much as HMRC want their money as soon as possible, they do appreciate that houses can take a while to sell, but it's not mandatory. They don't have to agree to it, and it's usually a 10-year plan with interest. So again, it's something that could be quite inconvenient, more expensive than it needs to be, and you'd have to liaise with HMRC. So it's just a bit of an awkward one that if you wanted to avoid, you probably would choose to do so. You can take out loans. They're often called bridging loans. You pay the inheritance tax due, you then get probate, you then get the house, you sell it, and you pay the loan back with the proceeds from the estate. But I'm sure you can all think there are potentially some trip ups in that plan. Property is an illiquid asset. What if it doesn't sell? What if you don't get the price you need? Bridging loans are expensive. They typically run for a year, maybe less. So with the rates of interest you've got there, if actually selling the property takes longer than expected, you could be getting into serious amounts of debt. So that's a risky option. It is an option though. Or you can use personal assets. Obviously you need to have them, and chances are, again, because nobody knows when they're going to die, that could be really bad timing. What happens if you need to use that option when you yourself are looking to buy a new house, you're moving home, you're downsizing, or you have another sizable purchase, or you yourself have a big tax bill that you've just become aware of? It might be very awkward timing. So while there are options available to you without a plan, like I said, they are last resort options. They're things you would want to avoid. They're stressful, they're more expensive often. It's just something you can get away with not doing if you plan appropriately. But reassuring, because I know sometimes you can't predict the future, there are options available to you in that scenario. So we mentioned at the start, the whole point of this presentation was, you know, estate planning. It's a puzzle. Why is it a puzzle? What's the problem with it? It's mainly because it's a worsening problem. So in 2023, IHT receipts received I think it was a record 7.5 billion. And as you can see, it's projected it's only going to go up. So for this tax year, they're expecting £10 billion in inheritance tax to be collected. and that has been going up dramatically. The thresholds that you have available to you and your family have been frozen since 2009. I attended another webinar recently where they had done the maths and said if that 2009 threshold had been adjusted for inflation at the time, there'd be something like an extra £500,000 of allowances available to you. So we're talking serious amounts of money just because these rates haven't been looked at, and they've been further frozen, so they're not planning to change them anytime soon. UK house prices have gone up, in the region of 80 to 90% since then as well. So on top of the frozen threshold, the place you live in alone is often going to be enough to start hitting those thresholds. Over £5 trillion worth of wealth is expected to be transferred by the baby boomer generation over 30 years. So your kids, your grandkids, who they themselves, via dint of being successful and having their own house in the southeast again, they could already be hitting towards these thresholds when all of a sudden they inherit a lot of cash or assets, and suddenly their position is significantly worsened. And it's not uncommon for finances to be a fairly taboo subject in a lot of households. People don't talk about these things. And again, having a plan in place is what helps resolve these issues. So a lot of people are going to be hit by that as well. And then pensions on top is being thrown in, as we've discussed. And while it's not going to be relevant to everyone, the government has also reduced business relief. So all over, estate planning is getting squeezed in terms of the options, the release, the allowances. More and more people are going to get caught out by this. Regular people, this isn't something that just affects the very wealthy anymore. This is going to be something that affects a lot of people. So how do you fix this? As I've already alluded to, it really is a case of discipline, really. Good planning, having a robust plan in place in advance and adhered to over time. This isn't something you can look at, plan, and fix in one go. You need to have it evolve over time. As we see, the rules change. You will need to change this in the future. You can't just fix it today. So the first step, though, is obviously to figure out, do you actually have an inheritance tax liability? And the simple way of doing that, calculate the value of your estate. So adding up all of those things I talked about in the first slide. You then deduct any liabilities. So if there's still a mortgage on the house or you have any other debts, they will be payable to those lenders. They will not form part of your estate. Consider any gifts you've made. That's a really important one, and we'll come on to that one. And then you apply any exemptions or relief that is available to you. And this calculates something called the net estate, and that is what they will apply inheritance tax to if it is over the threshold allowances. So here are the main exemptions. You might be aware of these to some degree, but we all have a nil rate band of 325,000. We have a residence nil rate band of 175,000, meaning an individual, if you have your own main residence, you have £500,000. Meaning married couples, civil partners who own a main residence can have up to £1 million of thresholds. The nil rate band is transferable, so your spouse can inherit it. The residence nil rate band is only for those who are passing a main residence onto, I hope you can't hear my rain and my microphone's doing on because it's just started bucketing it down. If you, for example, with the Mr. A I talked about, he didn't have any children, he had nephews, so he didn't get that £175,000. And I've had plenty of clients in that scenario where they don't have children. They might have sisters or brothers, they might have nephews, they might just have good friends or neighbors they want to benefit, but it reduces their allowances. And it is also tapered. So you can lose that 175,000 if your estate is significantly over £2 million. Really important point I can add to that, though, is we'll come on to this, but gifts you need to survive them 7 years for them to be effective and fall out of your estate. The residence nil rate band tapering is based on the value of your estate, not on any timer. So if you had an estate of 2.5 million, you could make a gift of 500,000 and you'll immediately restore the residence nil rate band, potentially, depends on your personal circumstances. You don't need to survive 7 years. So that can be a very effective option for those with estates over £2 million as a starting point, is looking at how do we get back that residence nil rate ban? Because if you get 2 lots of those, that's something like £140,000 worth of IHT saved just by making one gift straight away, potentially. And there is another threshold for business relief assets. This is the thing that you'll have seen farmers protesting about in the news. So before, it used to be 100% relief. So you could have 10 million, 20 million, 30 million in business relief assets. It would be wholly at a rate of 0% for inheritance tax, but they've now limited it. It was originally 1 million, and because of the feedback they got on the protests, they've upped it to 2.5 very generously of them. And there are other thresholds related to investments, but to keep this presentation breezy, I'm not going to go into that much detail. But obviously, if you have any questions on these kind of things, please feel free to pop it in the Q&A box, or if you want to have a more private conversation, feel free to email us directly or give us a call. So what are your options to actually reduce the bill? Simply spend the money you've got. It might sound straightforward, but you have to balance it against, do you want to give money to kids? What about long-term care costs that might come up? But quite simply, that's the most effective way of doing it. If you can spend the money, it's not there for HMRC to charge 40% on. But I know some people, do get to a comfortable position where it can be a struggle to spend the money. Spend the money. In that scenario, you might want to consider gifting. You do need to survive 7 years. If you die within 7 years, the gift falls back in your estate. And the downside to gifting money is you lose control of it. So it has to be a true gift. You can't retain any sort of benefit to a gift. If you're giving money, property, any asset, you can no longer get anything from it effectively for it to be an effective gift. So it's a loss of control of assets. And then if you bring it back to things like, if you need money in your lifetime for retirement spending or care costs, that's another thing to balance it against. You can move assets into inheritance tax relievable investments. That's the business relief I was just talking about. You have 2.5 million of an extra allowance, for example, which is obviously very large, but it is available. However, business relief assets tend to be very high risk. The reason they have relief is because they invest into nascent companies, and unlisted, unproven new companies are one of the highest risk investments you can make. They can fail entirely. So you have to be comfortable in terms of the risk level you're taking there. And there's options for simply paying the tax. So usually what I see is a blend of the two. If you can completely get rid of the inheritance tax bill, brilliant. But for a lot of people, because of the property values we see today, there's usually an unavoidable element of tax to pay. And usually that's where you might look at the direct payment system I mentioned, just keeping a bit of money to one side, knowing that it's earmarked for that purpose. Or alternatively, you can insure the liability. So you can pay a monthly premium into what we call a family trust. And when you die, it will pay out a lump sum free of tax, free of inheritance tax as well, that your beneficiaries can use to pay directly to HMRC without the need for probate. It's a very effective way of dealing with it if there's a bill remaining, or perhaps if the bill isn't particularly large. But there are pros and cons to these options. And again, not to go into too much detail, it's just highlighting these are available for people. So what about trusts, Oliver? This is probably the number one misconception I come across. I'll put my house into trust. I'll gift it to my son or my daughter or neighbor or dog, what have you. Then it's not going to be charged to IHT. And also the council can't have it for care costs. Unfortunately, that almost never works, simply because it's just another form of gifting. And as we discussed on the gifting slide, you have to have no residual benefit to that property. And usually that's the house you live in. So you're going to be living in it, and that very much is a benefit in HMRC's eyes. You can get around that by paying market rent to the new owners, whoever you gift it to. But generally speaking, market rents these days are quite high, and it makes it quite an unattractive option. So realistically, if you're living in the house, if it's your main residence, there isn't really an effective way of gifting it away to somebody or to a trust. It simply doesn't work most of the time. Another one I get is, well, if I give 70% of the house away and, my parents keep 30%, there are specific HMRC rules for that. They have to have that 30% as a contained living space. So you'd need to install new bathrooms, new kitchens, etc., so that it's own separate living space. And from the times I've seen that, it's just not viable. So if you're thinking of these options, maybe have a chat with me, because chances are it's not going to work, I'm afraid. However, trusts do very much have their place. They give you flexibility. They give you certainty that your wishes are being adhered to, because you will set up a trust with a trust deed, things like letters of wishes, where you can specify, this is what I want this money to be used for, and these are the beneficiaries. The trustees you put in place, you control who they are, and they do also have flexibility. So for example, they can change beneficiaries depending on the trust type. So it gives you a lot of control over where your money's going, and that might be relevant, for example, if your children are a lot younger. Generally speaking, most people don't want to give sums of hundreds of thousands of pounds to people in their early 20s. They might be more sensible and they might be okay with it, but generally speaking, it's not really something people want to do. So trust could have their place there. However, they are expensive and they are complex. So you have to balance up those costs and that complexity versus the benefit your estate will receive. And it's not uncommon for me where I see somebody say, I'll do a trust, and it's just a case of, why not just spend it or gift it? You don't necessarily need a trust potentially. But if you do have that scenario where you've got the younger beneficiaries, or perhaps a disabled beneficiary, a vulnerable beneficiary, trust can absolutely have their place. So just to run through some quick case studies before going into question and answers and seeing if we've got any. We had an individual with a £1 million plus estate who had a disabled beneficiary. So they're very much in inheritance tax territory. How we helped was providing her a detailed report on her position. So we assessed the value of her estate, we calculated the likely inheritance tax liabilities for her, and then we explained to her how she can reduce and simplify her estate. So when she's gone, everything's in order for her beneficiary. And for the remaining IHT, because there was still a little bit to pay, we figured out a way to cover that. The result, we recommended a whole of life policy, which is the insurance option we mentioned. We also then funded that whole of life policy by tax efficient withdrawals from assets within the estate. So we're spending assets in the estate, we set up the insurance policy. That allowed them to keep the family home, which had received significant adaptations in terms of accessibility and whatnot. So it was very important to them that their beneficiary received that property rather than the value of the property, because it was the property itself they needed. So that is a very good example of how robust estate planning advice can help somebody in that scenario. And they also have peace of mind that their beneficiary is sorted, which is what we already all have in mind for our beneficiaries. And just to run through a few more ones, we've had a chap here, he's got an estate worth 950,000. He's unlikely to ever spend the 500,000 because he had a mixture of state pensions, defined benefit pensions from old employers. He basically had more than enough income that he'd ever need. So it's very, very difficult for him to reduce his estate value realistically. So it's under the 1 million. However, it could grow over time, as cash and investments can do. So he was worried though about giving up money, because while he's unlikely to spend the 500,000, what if he needs care, for example? So what we did here is we helped set up a loan trust for 325,000. Loan trust capital remains accessible to him. It's still part of his estate, but if he needs to have that back, he can get it back. But the growth falls outside the estate. So effectively, this allowed him to cap the value of his estate well below that £1 million threshold, while still giving him the control. So it solved his issues in a very tidy way. And just a few more smaller examples that we come across. People might sell a business, you suddenly come across a lot of capital. Maybe you've got enough that you've lost the residence nil rate ban because your estate's now over 2 million. You don't get business relief. That business you were running, the shares you held as director, if it was in that structure, you could well have qualified for business relief. And once you've sold them, you don't have that anymore. So figuring out what to do with the proceeds of that business Very, very important and very well worth getting advice for. I've mentioned this before, but what if the property is primarily held, sorry, the estate is primarily held in property? You might have minimal liquid assets available to actually pay the bill. Or if you don't have any lineal descendants, I had a couple of people last year, they didn't have any children, they just happened to have grown up in London in a family home that's been with them for several generations. And obviously it's in London, so it's now worth over £1 million, and they had a very large IHT bill they were unlikely to be able to easily settle. Things like equity release can come into there, but you absolutely need advice on that. So that's an issue that can come up a lot. Or just things change. Pensions into estates, for example, business relief depends on the qualifying nature of the underlying asset. So that could change. The legislation hasn't, but it's just they're no longer eligible for the relief. You receive an unexpected inheritance, or perhaps you've just left things too late and you're very limited on time. All of these things can be helped with financial planning. So how we can help? We offer a free consultation, which you probably already know of if you've come across us before, where we basically run through things. We see if there's anything we can help with. Sometimes there aren't things we can help with, but when it comes to estate planning, usually we can help. So we let you know if there's anything you could do or not. So feel free to get in touch, give me a call, drop us an email if you want to have more of a conversation here. Here's our contact details, and otherwise, thank you very much for bearing with me. I know we're pretty much bang on time for half an hour, but I don't know if anyone's left any questions. No questions. Well, I don't know. I heard it beep. I don't know if that was the question. Oh, someone else coming in. Okay, they're a little bit late. Unfortunately, we've just finished. But like I said, if you do have any questions, perhaps you don't want to put them in a public Q&A channel and you want to have more of a private conversation, like I mentioned, drop me an email, give me a call, ask for Oliver. I'm more than happy to have more of a conversation. So I said this was very high level initial stuff. It wasn't hugely detailed, but there is a lot of complexity here. And when it comes to estate planning advice, the numbers involved, good advice can potentially save you tens, if not hundreds of thousands of pounds. But like I said, it requires that discipline to actually develop a plan and adhere to it. And when you're working, you've got family, you've got health, life gets in the way, it can be difficult, but we can take that burden off you. Let us help you with those things. And that's what we do. We love doing it. It's interesting, it's exciting for us, and it saves you a lot of money usually. So it's a win-win for everyone. But yeah, don't think there's any further questions. This has been recorded, so there will be ability to rewatch it, and stay tuned as well. I am planning to do more webinars in the future on a variety of different topics. For example, next April, I'm definitely planning to do one on once they finalise those pensions rules. I'll be doing one on that, for example. So keep an eye out for further invites. Otherwise, thank you for your time and enjoy the rest of your day.